funds, AmInvest. And to his right, we have Mr. James Dawson, European Equity Product Manager, Schroders. Schroders is the investment manager for Schroders ISF European Equity Alpha, which is the target fund for Schroders European Equity Alpha. Now, we would like to invite Mr. Chze to begin his presentation.
Thank you. Good afternoon to James and good afternoon everyone. Thanks for being here with us. And just now somebody was just asking me, why are we here talking about the European market and not Malaysian market? And my answer was, European is such an attractive place for us to consider investing into. And James is going to prove it to you afterwards with his many arguments and justifications. But let me give you a 5 minutes introduction about AmInvest, just in case you're still new to us. Alright? So that is our asset under management. As many of you like to ask me the questions of, how well have you done in the year of 2013? Let me show you that in the year of 2009, right after the Lehman crisis, we are below 20 billion ringgit asset under management. But for last year closing, we reached 35 billion. So that makes us definitely the top 3 asset managers in town. Another common question from the press is also, so how many funds have you launched? What have you done for last year? Let me just tell you that I have launched 6 mutual funds for the year of 2013 and 8 private retirement schemes. So the 8 private retirement schemes are relatively new, as you know, but we have actually rolled out quite a number of it. And for the year of 2013, we have been very focused in Asia Pacific, if not our home country, Malaysia. But over the last couple of months, we have been placing a lot of emphasis and focus in the European market, and I will show you the result in a while's time. AmInvest, the track record of our in-house managed equity funds, we have done very well over the last 2 years. The awards we have won in the year of 2013, not just in Malaysia, but even from World Finance, from Hong Kong, also to be the best Islamic fund manager. Okay, let me show you the market indexes, the important market indexes that I think the Malaysians are interested, and this is for the year of 2012. Why would I want to show you something that is so long ago? There's a reason behind it, but let me show you. The world equities has actually climbed up by 16.7% in the year of 2012, and US has gone up by 16%. European market was haunting everyone. It hit the headlines almost every day, but the market has gone up by 19.6%. Asia Pac was the winner, 23.2%, and Malaysia was quite average, 14.4%. So if you can remember, in the year of 2012, it was actually quite eventful. There were geopolitical tensions, there were natural disasters, many countries went into re-elections of presidency. And in the year of 2013, the bad news doesn't stop. The bad news didn't stop, and we continue to talk about, fiscal cliff, QE tapering off, debt ceiling. But let me show you the result of the last 12 months over the same indices. The world continued to go up. The US has performed 32%. All right, no joke, this 32%. The European market not bad, 32%. Asia Pac was a laggard for the year of for the last 12 months, 3.9%. Malaysia continued to hold up very well. But because of the performance of 2012 and the performance of the 2013, as we know, the developed world has recovered, the developed market has recovered. And that is what you see in the news. The Europe stocks reflect growing confidence in recovery. So that is from the Financial Times. European stocks seems cheap, relief from high US valuations. The Europe has valuations advantage on US stocks. Last but not least, super cheap compared to US. So we have got a fund. It's known as Schroders European Equity Alpha. Even though we are one of the top asset managers in town, but we don't know how to manage everything in the world. So what we have done for this fund is, this is the feeder fund. Schroders European Equity Alpha belongs to AmInvest, all right, the company that I'm representing. But we actually feed at least 95% of investors' money into the Schroders European Equity Alpha Fund. And Schroders is a world-renowned asset manager. And here we have today, it's our pleasure to have James, who works out of their London office, to be here with us to explain more about the European market. But before that, let me tell you, the timing is so good that when we make a very strong call for Malaysian investors to invest in Europe, you see the fund size actually grow quite exponentially from August to December. All right. So our fund size has grown by 180 million ringgit. We are now about 200 million ringgit. And if you look at the performance over the last 6 months, Schroders European Equity Alpha has gone up by 28%, and over the last 1 year, it is 37%. So to answer the question, just now somebody has asked me, why not Malaysian market? Let me tell you, the Malaysian market did not go up by 37% over the last 1 year. So your investments of 10,000 will generate a profit of 3,700 for you. Okay, just some facts.
Sure.
This is an opportunity for us to consider Europeans' growth prospects and exposure to improving fundamentals across Europe. We think the bad news is still out there, but I see better news coming up, better statistics, better data, and better confidence. European being such a big continent is diversifications across the country, sector, company, and different businesses and market caps. So the fund details is in your handouts. I should skip this, but that is the country allocations of this particular product right now. 23% in UK, for example. France, about 17. Germany is only about 5.8. Maybe you want to ask the question, why Germany is only 5.8? Sector allocations, financial is very high, 18.1. Fund managers, has got a lot of weightage, but that is also because of the index weightage. All right, the top 10 holdings, many familiar names. Okay, so now as AmInvest see a lot of potential, and we have the opportunity to work with the international fund manager Schroders, let me quickly introduce our special guest for today, James. He joined Schroders in 2004 as product specialist and product manager, and previously worked closely with two others asset management company, and he is highly qualified with CFAs and a graduate in London School of Economics with economics degree. And now I won't steal the limelight anymore, and here we are, his slides and presentations to all of you. Over to you, James.
Thank you very much. Thank you for being here, taking the time. I think I'm only supposed to talk for 20 minutes or so. Josephine is very strict with me, so I will probably whiz through some of these slides quite quickly. But of course, we have plenty of time for Q&A, so if you want to come back to anything that I talk about in more detail, please do feel free to say so. I think it's helpful to, first of all, look back and assess the global backdrop, because we can't look at Europe in isolation. Clearly, this is a competition for capital, and we need to know what's happening elsewhere in the world. And you can see here, we're just tracking the real GDP for various countries since the last peak in early 2008. And as we know, it was a fairly brutal recession across developed markets. And you can see the recovery has been quite esoteric in terms of what's done well and what hasn't. US is the standout leader from a GDP perspective. You can see Germany's done quite well within Europe, Japan looking better, UK recently in particular looking much better. You can see Eurozone in aggregate is the royal blue line. And within that, of course, we know Germany's done quite well, but countries like Spain and Italy, for example, have not done so well in terms of the recovery. From an interest rate perspective, and I think this is very relevant at the moment, we can talk a bit about tapering as well, of course. Official policy, as it says here, has been to depress rates recently. This has been part of the fallout from the financial crisis. Very, very low interest rates across the developed world. What we're trying to illustrate here is if you are buying government bonds in places like Germany, UK, or indeed the US, you are struggling to make a real return. The line that runs across here is the Schroders economics team global inflation target for the year 2014. So anything below that line is loss-making after inflation. Speaking of monetary policy more generally, what's really interesting about the equity markets over the last 4 or 5 years is how they've reacted to policy. So you can see here a price chart of the MSCI World at different points in time where you've had QE1, QE2, QE3 obviously, the LTRO announcement, the Draghi, whatever it takes, comment in the summer of 2012. This has been what's moving markets, what politicians have been doing and what politicians have been saying in recent years. I think it's particularly relevant to think about this at this point in time because the question has to be, well, what does tapering mean for markets? What does a path towards higher interest rates mean for equities? And the short answer is history would suggest it's nothing to panic about from an equity perspective. It may worry you from a fixed income perspective, but not for equities. So here what you see on the left-hand side is the behaviour of the S&P, i.e. the return of the US index in the last 3 major Fed tightening cycles, so 94-95, 99-2000, and 04-06. And you can see that in all of those tightening cycles, equities have generally done okay to well. Fixed income is a bit more mixed, but equities have outperformed bonds quite meaningfully in each of the prior 3 major tightening cycles. So do we as equity investors have to panic about tapering? I don't think we do, and that's particularly the case in Europe, which I think is probably the region that's least affected by tapering. In terms of forward-looking, where do we go now? These are some of the PMI numbers for the global on the top left, and then US, Eurozone, and UK, and a very positive picture generally throughout. Readings above 50, for those of you that may not be familiar with the PMIs, are taken as positive, so incrementally positive above 50, negative below 50. So all above 50 and trending upwards, which we think is a good sign for economic activity generally across the world. Before I move on to say a bit more about Europe in detail, I think it's worth remembering where we've come from in terms of market performance. So this is again going back to 2008, looking at the dollar performance of the Japanese, US and European market. Now clearly if you looked at these in local currency for Japan and Europe, you'd see a slightly different picture. But the reality is the US has outperformed both Europe and Japan quite meaningfully over the last few years. And that's a theme that I'll come back to in terms of where opportunities are for us now. So moving on to Europe in a bit more detail. Again, in terms of GDP, initially you can see it's a bit busy this chart, I apologise for that. The bit I would highlight is really around the middle. The EZ is the Eurozone in total, and of course you've got some individual countries around that, some Eurozone, some not Eurozone, like the UK for example. But we've had 2 quarters of successive growth now, Q2 and Q3 this year, after a prolonged recession. And I think while it's difficult to get very excited about the absolute magnitude of these numbers, the fact that we're growing at all, I think has been taken very, very positively by the market. And as I've said, we think there are reasons to be very optimistic about growth going forward in Europe. Funding costs has been one of the major issues, obviously, for those governments that have been under pressure. You can see on the left-hand side the 10-year yields that you're having to pay in Germany, France, Italy, and Spain, to the governments in those countries. And the German and French yields have been fairly steady, actually, over the last couple of years or so. The Italian and Spanish yields, obviously, as we know, have spiked out through the crisis as people have become quite concerned about what's happening in those countries. So what's really important here is that you start to see this converging, and you are seeing that now. And actually, if you look at the prior peak around the middle of 2012, it coincides almost perfectly with Draghi's "whatever it takes" speech. So you are seeing that compression now. People are generally, I think, are a lot more relaxed about Europe than they were 12 or 18 months ago. That also, of course, has reflected itself in the equity risk premium. This is just telling you what is the difference between the earnings yield on the equity market and the corresponding 10-year government yield. So essentially, it's a relative valuation measure of equities versus fixed income. And unsurprisingly, it's come down quite a bit from the prior peak as the equity market has outperformed. But it's still only coming down to what you would consider to be a normalised level. So this isn't telling you by any means that equities are expensive versus fixed income. It's all relative, obviously, to where they were in recent history. I think one of the fundamental problems of the Eurozone, and this is something that's been much discussed in Europe, has been this divergence of wage costs. So you cannot remain competitive as a country with runaway wage inflation in a single currency. You know, normally the way you would restore your competitiveness if you do have runaway wage inflation, or just inflation generally, would be to allow your currency to devalue, which is what Italy had done for 20 years prior to the euro. But of course they can't do that. So one of the, I think